We're going to good. So great to see you today. So today's workshop is on the finance mastery. So I know Gav has been to a couple over the years. I think Drew, this is your first one. I don't think you've been to one of my workshops before.
No.
No, cool. So that's always good to have a. Have you been to any action coach stuff? I think you've seen Brad talk, haven't you?
Yeah, I've seen Brad talk and I've been to the 90-day planning, but we don't work with Mark over the last 18 months now.
Okay. Cool.
So not done any action coach for a while, yeah.
Okay, so you've done a bit of that, so you'll understand a bit of what I talk about as we go through here. But certainly with the finance one, I mean, my background is chartered accountant in practice, into industry, finance director of a fast growth company. Then I became a freelance finance director for a number of fast growth companies. So, I've lived and breathed all finance all my life. My dad was a chartered accountant as well. So, he was teaching me double entry bookkeeping at about the age of 12. So for me, this comes extremely natural. I find it very easy, to be honest. But I also find it the most difficult, therefore, to teach, because once you know something without even thinking about it, sometimes it's difficult to teach, so you assume far too much. So, as I said to start with, please don't be scared to ask a question, even if you're worried, oh, that might sound like a stupid question. There really isn't a stupid question, only the question that you don't actually ask. So the finance workshop is part of a series of 6 that I do. I do 2 a month, and they repeat every 3 months. So we cover self-mastery, time management, basically finance, marketing, sales, customer repeat business, and team. So every 2 weeks there's one of those. They're all recorded, so they're all on my back catalogue of YouTube videos as well. So if you ever want to come back and revisit one of these, then please do. But I also say to people, look, do come on to them again and again and again, because actually talking to people takes us down different alleys. We start exploring different things in more detail, because certainly with a small group like you two, we can go into a lot more specifics as we go through. So when we look at sort of success in anything in life, if we're trying to learn this stuff, for me, this formula I use time and time again. Who do we need to be? What do we need to do? And therefore equals what are we actually going to achieve in life? So these are our dreams and our goals. This is our attitude, knowledge, and skills. And this is our plan of action. Okay, now, because Gareth, you haven't been on this before, and Drew, you've not done one of mine. Out of those 3, who do I need to be? What do I need to do? What do I want to have? Which do you think is the most important? So is it the be, the do, or the have?
I'd say they're all quite important, really.
They're all. You must have them all, but for me, one is more important than the other 2.
I would say
go with do.
Drew's the do. Okay, and Gareth, you're going for the.
I'm going for the have.
The have. Excellent. You do remember from previous workshops then, because I have done this a couple of times with you. So Drew, the do, yes, very important. But what we find with the doers is they become busy fools. Okay, they keep doing and doing and doing, but they're not necessarily moving things forwards. Yeah, the bees generally love learning, and they learn stuff, but they don't actually apply the knowledge. For success, for me, is the people that have real clarity of what their goal is. They're the ones that become successful. Okay, because once you know what you want to have, then you know who you need to be and what you need to do. So when it comes to finance and finance mastery, that have is even more important. And we'll come into this when we look at the bigger picture of the business. But for today, we'll keep it nice and simple. Yeah. What I want you to just have a think about, and then just sort of share with me, is what do you want to get out of today? So what is your have around finance for today? So if there's some specific questions you want me to answer, let me know. If there's some particular areas that you feel weaker on than others, then let me know as well. So so it can be one thing, it can be a dozen things. I'm not too fussed. I've got my slides that is going to cover, I think, most things, but again, if you've got specific things, I'll make sure I deviate to actually cover those. So Drew, what would be on your list?
I suppose what a finance director has to do or does, been running this thing now for over 5 years.
Yep.
Make profit, cash flow, touch wood, great. Everyone always gets paid on time, etc. But recently we worked with a mentor, and one of my roles is I'm the MD of the company, but also I'm the FD. What is an FD? It doesn't make sense. It's am I doing everything correctly, or is there stuff missing? And what does an all-rounded finance director look like of a growing company, basically?
Okay, perfect. I've got the slide just for you for that one. Yep. Gareth?
Kevin, I think you pretty much know our situation. Myself not being financial in the business at all. I'm mainly operations and project management from that point of view, going into business development.
Yeah.
I ran my own business in South Africa for 25 years. So I'm kind of a fay with my haves. I know what I want and I know where I want to go. My problem is addressing people to get things done so that I can reach my haves.
Okay.
It's kind of like a completely different angle from where Drew's coming from. And I know where Drew sits because I've sat there myself. I've been there.
Yeah.
And understanding the business is okay, but if you don't have the resources behind you to build that business, it becomes quite difficult.
Yeah. I think there's only two resources really in business. One is cash and one is people.
Yep.
Okay.
And if you haven't got one, you haven't got the other. So
if you haven't got one, if you haven't got the people, you'll never make the cash. And if you've got the cash and no people, then you'll never grow a business. So you've got to have those two. And go back to your question, Drew, what does the finance director control? To be honest, both of those numbers, the cash that's available, and make sure that it's being invested in the right place, in people, in equipment, in systems, in processes. That's one of the things. The other interesting thing is you saying that you're the MD and the finance director. As you'll see when I come to it, they're the only two roles that really understand the business as a whole, that have to understand the business as a whole. The other roles don't need to. It's good that they are, and that's why it's good to have people like Gareth on here who are sales led, but they don't need to have an understanding. But unless we all understand how the game of business is played, then we can't play the game. It's a bit like Gareth is a good goalkeeper, but he's got no idea how football is scored. Well, how is he going to be a good goalkeeper? How is he going to throw the ball out? All he's interested in is his own little game that he's playing. So we've got to understand this whole game of the business so that we can all play at a higher and a better level. So
that's
cool. Okay, so look, we could definitely.
Sorry, Kevin.
Go on, guys. You go.
I was just saying that's kind of where I fit in at R&B, in the sense that I'm there trying to manage and monitor the money that's going out to try and get the money to come in.
Yeah.
So although, like you said, I'm not the FD or the MD, part of sales is, like you said, understanding the business and understanding where the business is going. I can't just go out there and start bringing in 200, 300,000 pounds worth of turnover if we don't have the staff to do it. It's a bit of like a catch-22 almost.
It's chicken. It's always chicken and egg,
And understanding that
never have
balance.
the right money at the right time, and when I do have the money, it's what do I do with it? It's so. And this is the game. This is what we're playing. It's like football. Football's never perfect. You're either ahead and you're trying to. Do you protect your lead, or are you behind and you're trying to catch up? This is what we're always doing in business. So as I think was it Sterling Moss said, if you're not if you're not prepared to crash, you're not going fast enough. We're always on that edge of failure, and that's really when we're generally when we're at our best. When we're not there, then we become fat, lazy, and we're not actually performing particularly well. So let's look at the be and the do then. So, part of the be within beliefs, what are our beliefs around finances? What are our beliefs around money? And what I find with certainly business owners, but also, team members, is this sort of, they see money as an emotional thing. Okay. So if I have loads of money, I have an emotion around having loads of money. If I have no money at all, I have an emotion around having no money. So it's very difficult for people to actually sort of, when we talk about money, not to have an emotion around it. From an accountant's point of view, okay, from a finance point of view, money is just numbers. Okay, there should be no emotion to the money at all, if we can help it. So when I, back in my finance days, I'm an accountant, I'm dealing with all these people's books. I have no emotion about anybody's bank accounts, their sales, their profits, their losses, their expenses. There's no emotion there. I am just there to process the numbers. It's a bit like, go back to the football, as the finance person, you're the person actually putting the score up on the board.
Sorry,
you don't support either team. Okay, so why would I get emotional about the game going on? I'm not there to cheer or shout. I'm just there. If they score a goal, I put the score up. So we've got to start thinking about ourselves, looking internally, is what are our emotions around money? Do we actually have, some negative beliefs about the money, about money as a whole? So what would be some negative beliefs that maybe not you have, but somebody could have about money?
Not enough.
There's not enough. Okay, there's not enough money. Now, if you watch the news, especially BBC or Panorama, it's like the world is going to end tomorrow, isn't it? Inflation, this, and there's just not enough money to go around. Yep. What would be another negative belief around money? What are some negative sayings around money? That's a good way to think about it.
Makes you greedy.
Makes you greedy. Yeah. Greedy people have money. Yeah. Cool. What else?
Never satisfied.
It's never enough. Yeah.
The more you want, the more you get, the more you want. Yeah.
Yeah.
Scared of spending and investing.
Yep. Scared of losing it. So the fear of loss, of losing money.
I suppose from my perspective, obviously when you start a business, there is no money. And the stage we're at now, we have money. And It's like, wow, we've got some money. Like, there's a buffer. I don't know, it feels strange looking at the bank account going, oh, wow. Years of slugging and it's paying off. I don't know. Is it too good to be true? I don't know.
Yeah. So we have, again, that's you can have a positive emotion about money. Oh, gee, I've got, there's lots of zeros on the amount of money I've got in the bank account, or there's no money in the bank account. We've got a big red number. There's a big overdraft. We have no number. So what happens is all of those thoughts that we have, the way our brains work is whatever thought we have, creates a feeling. And that feeling drives a behavior. And that behavior then drives another thought. Okay, so imagine you look at your bank account and there's nothing in your bank account. What would be a feeling when you had nothing in your bank account? When you started your business, Drew, nothing in your bank account, what's your feeling?
Well, one of them is get selling. And then I suppose when you're first starting out, is this viable? Is this got legs, etc.? But touch wood, don't have that feeling no longer.
So you took you looked at the bank account, saw no money in there, and you thought, geez, I've got no money in it, so I've got to get off my arse and I've got to go selling. Okay, so that feeling, that negative feeling, drove a positive behavior. Yeah, you did some sales and you made some money, so you go, hey, that's working, so I'll do more of that. Yeah, now you've got loads of money in the bank account. So, yeah, now what's your thought? I've got loads of money in the bank account, so what's your thought, feeling, and behavior?
Keep it.
Keep it.
Like what I mean by that is, as in, don't spend it as quickly as it's come in, if that makes sense. So yeah, it's not, don't even take out extra dividends, don't upgrade this, don't invest in that. It's that kind of, now you've got it.
Yeah. So is that feeling now driving you to do more sales because you've got loads of money in the bank account? Are you really driven to do more sales?
Probably not as much.
No, not as much, are you?
Until next month.
Okay. Now, if you think about it, because you've put an emotion to it, what got you to here? Why don't you just keep doing what you did? Because it worked. So why not do it again and again and again and again? But what we don't is because we suddenly think, now I've got lots of money, now I've got to protect it. So suddenly our mental thing shifts from taking the risks and doing what we need to do to get the money to a complete change in the way we behave in order to hang on to the money. And this is why businesses grow and then they plateau. Because I've got to a certain stage now where I don't want to lose what I've got, and therefore my whole mentality and my whole behavior changes into one to protect. And it's built into us as human beings, that we're driven away from pain. And once we're away from pain, then we like to maintain the status quo. So now I'm earning a reasonable salary. I can pay the bills, I can pay my taxes. And therefore, right, okay, we'll take it easy now. Whereas if you look at the successful entrepreneurs in the world, they go, well, that's not enough, so I want more. So their behavior continues in what got them to where they are to keep going, because their goal is so much bigger than where they are. Okay, so we've got to be very careful about this emotion that we attach to it, because sometimes it can help us. I don't have any, therefore I'm driven forwards to get more. But it can also be negative, that I have loads, but I don't want to lose it, or I have none and therefore I can't do anything about it. So they also say, people are either poor or they're broke. Okay, poor people have a mental thought that they're poor and they'll always be poor, and therefore their behavior is that of poor people. A broke person is a temporary thing. I'm broke at the moment, but I'm going to get some more money back. So they're empowered to move forwards, whereas poor people then just sort of stay in their rut and never move out of it. So we've got to be just thinking about this thought and behavior in order to move us forwards, because these thoughts are often fears that we have that are just false expectations appearing real. I have no money in my bank account, and therefore, I won't be able to pay the bills, and if I can't pay the bills, somebody's going to close my business down, and then I won't be able to, live, etc., etc., etc. We're very good at projecting into the future. So we've got to be careful with these fears that they don't stop us. And it's a bit like the rabbit in the headlights. I don't have it, and therefore, I freeze, because that's another one of our fighting mechanisms: fight, flight, freeze. So I freeze and I do nothing. Okay, so we've always got to think the numbers are just the numbers. They are just a reflection of what's happened in the past. I can change it. I can change it for the good, and I can change it for the bad, you know, if my actions aren't the right actions. So we've got to start seeing numbers as non-emotional. Okay. But with a view that, right, what am I going to do with these numbers? There's no point in having a set of numbers if they don't then inspire you to go and do something. So if it's a big number, great, fantastic. Let's use that to get a bigger number. If it's a low number, great, let's move it forwards to make it a bigger number. Okay, it is just a scorecard, which I'll come on to in a minute. So therefore said that numbers are both left and right brain. They're logical, analytical. That's the bit that I love about numbers. They're just black and white. You know, a number is a number, can't be anything else. But they're also emotional. So we've got to be careful with this emotion that we're not driven by those negative emotions. That positive emotions are great, but within a, you can't have that positive emotion that says, yeah, I've got £50,000 in the bank account. Great, let's go and spend it. Let's go and buy that Ferrari that I've always wanted, and then blow it. We've got to be thinking rationally, logically about what we actually do within our strategy. They are just a reflection of what's happened. They're not a predictor of what's going to happen. Okay, so just because we made a loss this month does not mean we're going to make a loss next month. If we carry on doing what we've done, then probably, yes, we will do that. But we've always got the power to change at any one time what we're currently doing to move forwards. Okay, so this is why I do often say, sorry about this one, Drew, but never put a finance person as the managing director of a company. Because that's like asking a racing driver to race around a track just looking in the rearview mirror. Okay, if businesses want to go forwards, they need to be driven by a sales-driven person. Yeah, you need a finance person as a co-pilot to make sure you don't crash, but the balance between the two is really where we want to be. And I've seen it so many times that finance people running companies, they're too cautious. They're looking after pennies, which is what they're good at, which is what they should do. But we want to be looking forwards as well as taking this reflection of the businesses, or the numbers that we have actually achieved. So the key to remember on this is, if you measure something, you can improve it. They say if you want to lose weight, what's the first thing you need to do if you want to lose weight? If you've got a weight program,
you've got to weigh yourself.
Weigh yourself. Okay, so you weigh yourself at the start, yeah, and then every single day while you're on the weight loss program. Okay, because what gets measured gets improved. If you read anything about the Olympic cycling team, the Olympic rowing team, there's a great book. Does it make the boat go faster? David Bracefield, was the coach of the cycling team. They measured everything, right down to the calories that the riders were eating, to the weight of the spokes, everything that was measured, because they were looking for that 1% improvement over a number of areas. So this is why the numbers within a business are so important. Okay, so they're very, very important to measure, but they are just a scorecard. They're just measuring what's actually happened. So if we want to improve them, then we've got to have the plan, and we've got to have the ability to actually then do something about improving those numbers. The numbers on their own are not going to help us. Okay, so when I go out and play golf, I'm recording the numbers because I want to see how well I've done. But the fact that I scored a 5 on one hole does not mean I'm going to score a 5 on the next hole. It's the game. The next whole game starts now. So if we break it down into and again, if you look at the numbers on a scorecard on golf, at the end of 18 holes, okay, you measure your score against par. But actually, golf is a far more complicated game than just that, because you've got how many putts did I do? How many fairways did I hit? How many up and downs did I do? How many greens in regulation did I do? So we can actually break just a simple game of golf down into 5 or 6 separate games. And each one of those, we want to see how we're doing and how we need to improve. So it allows us to break down into its component parts so we can look at each one, improve it, put it back together. It's the Kaizen philosophy that the Japanese brought into manufacturing in the 60s and 70s. Constant and never-ending improvement. And we improved by measuring things and then improving them and then remeasuring them and making sure, have we actually done what we said we were going to do? So numbers are important because they are the score sheet. They tell us how we're doing. They're a barometer. You know, they can motivate us. They should motivate us. If our numbers don't motivate us, then we're probably looking at the wrong numbers, or we've got the wrong emotion around the numbers. The bit I love about numbers is doesn't matter what language you speak, you know, where you come from, you know, they are universally understood. Everybody understands, you know, what numbers are. EBITDA is the ultimate sort of, you know, profit figure, you know, is known around the world. You know, we could all talk in the same language when it comes to numbers. Languages are different, but when it comes to numbers, they are universally understood. We can compare and contrast. You know, they're this reflection of past decisions, but they should make us make better decisions going forwards. And they are what business is all about. You know, business, when it comes down to, actually is a numbers game. You know, that's how we keep score within the business. So we need to start looking at who owns what numbers. Okay, now this is the bit that I said, this is a slide for you, Drew. Okay, and also for you, Gareth, as well, because you have to see the big picture. Okay, because we're all playing our little games within the game, but if you see the big picture, then it starts to make a lot more sense. So if we look at the top of an organization tree, okay, right at the top of an organization tree is the shareholders. Okay, now if you think about a shareholder in a company, yeah, how many hours a week does a shareholder work in the company? 0. Yeah, so if I own shares in Tesco's, okay, how many hours do I work in Tesco's? None. Okay, but why have I invested in Tesco's? What do I want as a result of my investment in shares in Tesco's?
Return on investment, more money.
Return on investment. Okay, and how do I get my return on investment? What are the 2 things that I get when I invest?
Dividends.
Dividends and
share price going up.
Share price. Okay. So I get dividends and share value. Now, as a shareholder, yeah, I have certain rights. Okay, what am I allowed to do? Okay, I don't have to work in the business, but what am I allowed to do within that business? What are my only legal entitlements once I own shares?
Sell them.
I can sell them. Yeah. Okay. Yeah. In addition to that, while I own my shares. Sorry, Drew?
Buy more shares.
I can buy more shares. Yeah, but legally within the company, there's a role I have to play within a company.
Have a say in how the business runs.
Have a say in how the business. Okay, so I'm allowed to do that, but in a very specific way. What's that specific way?
Voting, become part of a board.
Voting at the
board level, directors level.
No. If you turned up at Tesco's with your Tesco shares and said, "I'd like to be part of the board," I think they might kick you out.
Is it by attending the shareholder meetings?
By attending the shareholder meetings. Okay, but I can attend the annual general meeting or any shareholders meetings, and I get to vote.
Sure.
Okay, I'm allowed to vote at the shareholder meetings, and generally I'm voting for the amount of dividend that's declared and who runs the company. So if I don't like the way my company's being run, yeah, I get to sack the board. Okay, that's it. As a shareholder, that's all I can do. I get to appoint the board, I get to sack the board, and I get to approve my dividend. I have no other rights within that company. And this is where it gets complicated in a small business, because we've got the business owner, the shareholder, Drew, for you, sort of Clive, that we're the shareholder, and so we can, our job is to go out and appoint the board of directors. So we go out and find the best board we can possibly find, who's headed up by what role? Who heads up the board?
The CEO.
CEO.
President.
Okay.
Yep.
The CEO. Now, I don't like Americanisms. I like the word managing director. So the first person I'm going to appoint as the shareholder in my company is the managing director. So for all the people that I could appoint as managing director, who do I appoint in most small businesses?
Yourself.
Me. Yeah, I've got no track record of being a managing director. I've never built a multi-million-pound business ever, but I'm the best person to run this company. As a shareholder, you'd go, okay, that's interesting, isn't it? So if I go back to the football analogy, if I'm the owner of a company, if I'm the owner of a football team, I go out and appoint a manager, who appoints his team. If that team loses, who gets sacked?
Players, managers.
The manager. Yeah, the players don't get sacked, do they? So in a company, what happens if the team isn't performing? Who gets sacked?
Manager, MD.
No.
No one.
The players.
Mm.
See, it's a bizarre thing, in a big corporate, you get appointed the managing director. Big corporate, you get paid a massive salary. If you don't perform, if you don't hit the shareholders' targets of dividends and shareholder value, you get sacked. The team don't get sacked. It's not the team's fault that the performance is bad. It's the manager's responsibility to get the team to perform. Because in order to pay dividend and shareholder value, what is the number one goal of the managing director? What does the managing director need to achieve in order to pay dividends and increase shareholder value?
Targets.
Profits. Okay. So if we think about our financial statements now, because this is a scorecard, our financial statements are the scorecard of business. The number on the financial statements the managing director is responsible for is the bottom figure of the profit and loss account. Okay, it's sometimes called the EBITDA, earnings before interest, tax and depreciation, but it's just an accountant's way of saying it's the operating profit of the business, the amount of profit the business can actually generate. Okay, so the managing director owns this figure because they have to report to the shareholders that I have achieved the profit calculations that you set me to do. If I do that, I keep my job. If I don't do that, I should get sacked. Problem is, if the shareholder is the managing director, they hardly like to sack themselves, aren't they? So the managing director then gets to appoint 5. In most businesses, there's 5 key roles. Okay, so we're going to look at these 5 key roles. So there's 5 director level roles that the MD, because the MD can't do this all on their own, they need a team around them. Okay, so give me some of the 5 roles. 5 director roles.
Financial director.
Financial director, that's 1. Yeah.
Operations director.
Operations director, 2. Yeah.
Sales.
Sales director, 3.
Sales and marketing, I suppose.
Marketing director 4. The one that everybody forgets about.
The one that we're not thinking of now.
Okay, I'll fill that one in at the end. Okay, so the first role that we fill is the marketing director. Okay, so if the MD's number one goal is profit, what is the marketing director's number one goal?
Leads.
Leads. Okay, so how many leads have you generated today? Yeah, that's what marketing is all about, lead generation. You know, all my marketing is there to generate leads. So if this person does their job well, we've got leads coming out of our ears. Yeah. So therefore these leads are then handed over to who? Which role's next?
Sales.
Sales director. Okay. So what's the number one goal of a sales director?
Targets.
Conversion.
It's conversion.
Sales.
Okay, I've got to take these leads and convert them into sales. So if you think about your profit and loss account, which is your scorecard of your daily trading, yeah, or your weekly, monthly, annual trading, these two people together are responsible for which number on your profit and loss account?
Turnover.
Turnover. Sales. Okay, so if I'm the managing director, and that's why I use the term managing director, not CEO, because the title is I have to manage the directors. Okay, so I've got to manage the marketing director and sales director. Now, if my sales are down and therefore my profits are down, and I come to my sales and marketing guys and I say to my sales guy, it's a sales guy, why are my sales down? Who's sales going to blame?
Marketing.
Well, give me crappy leads. If I go to Mrs. Marketing Director and say, Mrs. Marketing Director, why are my sales down? Who are they going to blame?
Sales.
Sales. I'm giving them loads of leads, but they're not converting them. So the managing director has to manage the relationship between these two and constantly remind them that the game that they're playing, their individual game, is leads and conversion. The team game, sales. So they have to work together. So the tension between these two roles that the managing director has to manage. If it's too loose, yeah, you fall off the tightrope. If it's too tight, the tightrope snaps. If these two work in harmony, then sales are coming in all the time. Now, the problem we have in a lot of businesses is, yeah, who's a shareholder? In your business, Drew?
The MD.
In your business?
The MD. The MD and the SD.
Yeah. So you're here, you're here, you're here, and you're here. Who keeps you accountable?
No one officially, but our
No one
mentor,
officially, yeah.
technically.
You have to keep yourself accountable, which, you know, at the moment you're wearing 4 hats, so it's pretty difficult. So now we've converted the sale, so now we pass the baton over to the next director. So the next director in the line is
Operations.
Operation.
Okay, so what's the number one goal of operations?
Deliver.
To deliver. Yeah, deliver how?
To the highest standard.
To a high quality standard, on time,
budget. within budget.
Within budget. Okay, so therefore, you know, on quality, there's a quality issue. So quality could be measured by returns. Yeah, on time is on time. You know, it's a fairly easy one to measure. And on budget means that the figure on the profit and loss account that operations is in charge of is the direct cost. So cost of materials, cost of labor, you know, anything that goes into the actual what we sell. Okay, so that's the game they're playing. They're playing the make sure direct costs are as low as possible. Okay, now for many businesses, that's a multifaceted. It's, you know, you could break that down into multiple channels, depends what you do, you know, but the essence of it at this high level is it's the sausage machine. You know, are we getting sausages out of our machine cost effectively and keeping the customer happy? Because if we do that, then we have a successful business. If we can't do that, you know, if we can produce it cost effectively, but we've got unhappy customers, we've got no business. You know, if we've got happy customers, but we can't make any money, we've got no business. So now if we think about this person, yeah, if we now look at the three of them together, the number on the profit and loss account that these three are responsible for is the gross profit. So if we're not achieving gross profit in the company, and I go to the operations director and say, yeah, Mr. Operations Director, why are we not getting our profit? Who are they going to blame?
So we're not selling at a higher value.
You've sold something I can't deliver. You know, you've promised them it's going to be there tomorrow and it's going to take a week. If I go to sales and marketing, because now these guys can team up, it's quite nice because now they've got a common enemy. They can team up and say, well, it's not us. You know, we're selling it the right things. It's just you're not able to deliver it on time. Okay, so this is the machine of the business. You know, this is what we're looking at. This is where you make or break the business in here. So let's assume that we've done the goods. You know, we've produced our sausages. We've done our job. Yeah, and then we need to pass the baton over now. So where does it go now?
Finance.
Okay, so now passing over to the finance team, the finance department, which is headed up by the finance director. So on that basis, then, what is the number one goal of the finance director?
Profit.
No, who's got profit?
MD.
MD.
The numbers align.
The numbers align, yeah. But why do we need to make sure the numbers align? So if you go back to the profit and loss account, let's start with the profit and loss account. Yeah, if these three are responsible for gross profit, what's this person responsible for?
Net profit.
No, net profit is the managing director. What's the set of numbers between gross profit and net profit?
Don't know.
Okay, we'll look at a profit and loss account in a bit. But it's the overheads. Okay, off the gross profit comes the fixed cost, the overheads of the business, the cost that everybody shares, you know, the building costs, the entertainment, all the other costs, anything that isn't directly attributable to sales comes under the finance director. So we've got to make sure that we're spending the right amount of money in the right place. Another statement, so you've got the profit and loss account. What's the other statement that makes part of your financial statements?
Balance sheet.
Balance sheet. Okay, so they're also responsible for everything on the balance sheet. So they have the goal of the financial security of the business. That's their number one goal. Financial security of the business. So with your FD hat on, Drew, that's what you have to be thinking. I'm in charge of the financial security of the business. Now, in most cases, does that role, financial security of the business, mean that you should spend more or spend less?
Depends.
It depends, but generally, what does it mean?
Spend less.
Spend less. Okay, so when the operations director comes to the finance director and says, I'd like to invest £100,000 in a brand new machine because it'll improve my output, what's the first thing that the finance director is going to say?
No.
Yeah. If this marketing director says, I want to spend another £10,000 on this marketing campaign, what's the finance director going to say?
No.
No.
2 words.
Okay, so now I've got this relationship between these four. These three always want to spend more money, and this person wants to spend none. So now, as the managing director,
is the other one a HR director? Is it?
Well done. So yeah, that's the last one. Okay, these four all together drive the net profit, which is the ultimate responsibility of the managing director. So I've got to get the MD, these four people working efficiently in order to make this one as big as possible.
Will you share these slides after the...
I don't share slides, Drew, but if you want any of them, just ping me an email and I'll send you a copy of one. So,
perfect.
Okay. It'll be on the recording, so you can always go back to it.
Yeah,
So
I'll take photos anyway.
So this is basically the game of business. You know, it's a bit like looking at a football team and going, we've got strikers, we've got midfield, we've got defenders, we've got goalkeepers. Every single business has this structure. Now, it's when you look at the business, you'll break it down. It'll be more detailed when it comes down to it, but the overall roles and goals and responsibilities are exactly the same. One that everyone forgets, which you picked up at the end, HR, because if all these people are doing their job well, they are driving their people hard. So I was just, did you see there was a post on LinkedIn today? It was an old Glenn Ross film about ABC always be closing, and he does this really tough talk to his sales team, basically kicks their ass, and that's what this is like. You are driving your team. So if there's not somebody looking after the actual people themselves and to making sure we've got happy people, then what we can have becomes a very toxic organization. It's just about profit. It's just about profit. It's make profit. And then you get the Enron scandals, you get all sorts of things that go wrong, because somebody's got to be looking after the corporate social responsibility. And the fact is, if we don't have good people, then we don't have a good business. So when we look at this, within the numbers of the business, because the people gives you the longevity, it's the future, because dividends, this drives profit. Shareholder value is its ability to generate profit into the future. So if we don't have longevity, if we don't have a great team, then we don't have a business. So we've got to be thinking, what is the goal? Well, the goal is, dividend and shareholder value, it's profit, then each individual player playing their own game. And if you break this one down, you could break marketing down into social media marketing, telemarketing, all the different, each one of those is playing a game within a game within a game within a game. So every game we play, we should have a measurement to say, how well are we doing in that game? If we can't measure it, we can't improve it. We don't know where we are. I've got no idea. I got no idea what my sales is, my conversion is, what my direct costs are, what my gross margin is. If I don't know these numbers, it's very difficult to play the game. We can run around the field faster, but is that helping? We really don't know. Any questions on that? Because that to me is one of the most fundamental things that, if we understand that, then we understand where we are in it. And certainly, in a small business, we're probably in all of these. And that's why it's so difficult, because, the finance director, should I be saying to the marketing director, yes, you can spend it? Or should I be saying, no, they can't spend it? Well, for me, the marketing director needs to come to the finance director with a plan, says, right, here's my plan, here's my return on investment. You give me 10 grand, I'll turn it into 100,000. But once I've done that, be prepared to be held accountable 3 months later when the finance director says, show me the money. Where is it? Where's your numbers? Oh, I don't know. No, well, there's, Google Analytics is not quite working. I don't have the numbers. Yeah, I don't want to see that. If I'm going to give you the money, then I need you to hold you're going to be held accountable to spending that and giving me a return. So shareholders want return on investment. Okay, dividend and shares price growth means we've got to get profit. So therefore, the game that we're playing within business is to make profit. And if we think about how a business is valued, when we value a business, it's valued on the net present value of future cash flows. So its ability to generate future into the future. You could generate profit into the future. And it's generally given a multiple of what we call EBIT, our earnings before interest, tax, and depreciation. Okay. Plus, any net asset value that is within the business itself. Okay. Now, for EBITDA, I'm not going to go into too much detail here, but it's basically earnings before interest, tax, depreciation, amortization. So profit from running the business. What they say is taxes are optional, depending on what your strategy is, means that taxes in different countries and different states and different companies are done differently. You have the depreciation, amortization is the writing down of your assets, and you get to choose that. So we ignore that as well. And interest is, some businesses are highly geared and some businesses aren't highly geared. So your interest again. So it's basically, it's taking all that out so we can compare one business with another business. And if I take the so interest plus tax, so minus plus interest and tax, gives your EBIT figure. But in effect, it's just the company's ability to generate profit. That's really what it's looking at. So we take that profit figure and then we multiply it by something. Okay. Now, the average multiple for businesses that are sold, and have always been sold, is around about 3. Okay, it's actually I think it's about 2.7, something like that was on this study. Okay. So an average business gets sold for just under 3 times its multiple, 3 times its EBITDA, its profit figure. Often people sort of say, well, why is it 3? Yeah. What we're looking at here is if I buy this business for £1 million, okay, I want my money back within 3 years. Okay, so if let's say it was 900,000, I buy this business for 900,000 because it makes £300,000 a year. So therefore, I put £900,000 in on day one, and over the next 3 years, I get 300,000, 300,000, 300,000. So I get my money back in 3 years. If I've got a better business, if I've got a really strong business that is going to be there for the next 5, 10, 20 years, then that multiple will increase. Okay, so great businesses can get that multiple from about 3 up to 6 to 7. Because I've got the systems, the processes, the people, I've got a brand, I've been in the market for a number of years. This business is going to generate profit for a lot longer. If my profit is on the up, okay, it will be even higher, because in 3 years' time, my profit might be 5 times what it is now. So the likes of Tesla, traded at massive, 5,000 times profit, because the profit now was small, but the expectation of that profit was much bigger. When I look at publicly traded companies, so if you go to the stock exchange, the average stock exchange business is traded at 15 times EBITDA. Okay, they call it a price earnings ratio on the stock exchange, PE ratio. Okay, but the average is about 15. So good businesses are around about 20, poor businesses are around about 10. So when we look to, the time comes to sell a business, if we can buy a business for 3 times and sell it for 10 times, we can make some serious money on buying, building, and selling businesses. But if our business is only ever reliant on us, yeah, if it doesn't have systems in place, if the profits are erratic, then no one's really going to want to buy it, because if I buy it, I'm not sure I'm going to make any money next year, let alone 3 years' time. So we've got to look at how do we get this multiple. And the profit up is one thing, which is obviously increased sales, increase margins, keep the overheads as low as possible. But the multiple factor actually has a greater impact on a business valuation. So if I had a business that was making £200,000 in sales, and I increased the profit to 250,000, by increasing sales and things like that, so 25% increase in sales, and it was let's say it was 3 times multiple, so that's 3 times 250 is 750. If I did nothing with a profit, kept it at 200,000, and I did work on the business and systems and got that 3 times to 5 times, suddenly I've now got 5 times 200, which is £1 million. So sometimes it's better to actually work on the systems and processes and the sustainability of the profit we've got, rather than keep driving for more and more profit. Okay, so these are things that the managing director needs to be thinking about, because it's their responsibility to give dividend and shareholder growth. So if my focus this year is shareholder growth, I might sacrifice a bit of dividend. You're not going to get your dividend, because I'm going to reinvest the dividend in systems, processes, and people. Okay, but these are decisions that you make based on the numbers that are in your business. And if you don't know these numbers, you're not going to make the right decisions. So the 6-step effects then, if we look at, I know, Drew, you've done the Action Coach system for a while. Gareth, I think you might have seen this in one of my previous ones, but there's these 6 steps that we go up. Mastery is about getting the basics right. Where are we going to go? Finance mastery, time mastery, delivery mastery. This is all about the multiplier. If you've got this correct, then you'll be at about that 3 times multiple. Okay, if you've got good basic systems, accounts, everything, you get a 3 times multiple. If you haven't got basic accounts or basic ability to deliver a consistently good quality product and service, you get nothing. Your business isn't worth anything. I'm looking at businesses now, and they're giving me accounts that don't make any sense. They're not good enough. Well, I can't value your business unless you give me some decent, consistent accounts. Then looking for niche. So this is the 5 ways, lead generation, conversion, number of transactions, average transaction value, margins. So this is all about driving the EBITDA figure, the profit. Then we look at the systems, the leverage and systems in. It is about multipliers. So if we're working on this, we're now working towards 4 or 5 times multiples. Add on that a brilliant team. So now we've got the marketing director, the sales director, the operations director, the finance director, the HR director. We've got this amazing team. Now we're at 7, 8 times multiple. Add in the fact that we can now go into synergy and results, which is where we start acquisitions. Then we can actually be working on the EBITDA and multiply. So we're buying businesses, absorbing businesses. So not only we're increasing the profit, but we're also increasing the multiplier as well, because now we're in a lot more different markets. We're a lot more stable going forwards. So the whole Action Coach system, the 5 ways, the 6 steps, is basically there to drive shareholder value. And that's ultimately what we've always set out to do, is we're building businesses that can be sold in the future, to actually build them better so that they work without the business owner, and therefore they have the systems and processes and people in place. So I said, what gets measured gets improved. So we've got to look at each of these and go, right, what are the measures that we need for each of these 5 roles? HR, sales, marketing, operations, and finance. And the easiest one to start with is actually finance. Okay, so within finance, you've got to have regular bank reconciliations. You've got to be able to do weekly cash flow forecasts. You've got to have aged debtors and creditors. You've got to have a monthly profit and loss account, balance sheet. You've got to have an annual budget, and then you've got to have your key performance indicators. Okay, so if you want to get there for those, that's really what you need. Now, I'm not going to go into too much detail around these because, Gareth, it's not that relevant for where you are. Drew, probably a little bit more, but I'm guessing you sort of know the basics on this anyway. So bank reconciliations these days in Xero. Do you use Xero, Drew? Xero, it's just a piece of, it's so easy now. You just push OK and it's sort of done for you. So cash flow forecasts, is predicting the cash flow going forwards. So a lot of businesses do this when they're short of money. I think you should do this even if you've got lots of money. If you've got lots of money in your bank account, the best thing you can do is take it out of your current account and stick it into a deposit account. Stick it into a 30-day deposit account. One of my businesses, I've now got it in a 90-day account. I can't get it out for 90 days because what that brings in is discipline to say, I haven't got this buffer, therefore I've got to keep hungry. I've got to keep moving forwards. Okay, because if you think, oh, yeah, I've got 100,000 in my bank account, then you get sloppy, you get lax, you get lazy, you stop chasing your debtors. If you've got zero in your bank account, bloody hell, your credit control is good. Okay, so don't allow yourself to get lazy by the fact that I've got lots of money there. Stick it away, hide it away somewhere, invest it somewhere. That's what you should be doing if you've got excess money. So we've got to put cash flow forecasts in. And if we want to improve cash flow, then, sell more, increase prices, reduce your debtors, reduce stock. If the finance director, financial security, they should be looking at the balance sheet and saying, is this balance right? Okay. Have I got too much invested in my stock, in my debtors? Do I need to bring those down? Could I borrow more money? Can I actually bring money into the business to improve cash flow? See, what I find in business is cash is like a river. Cash should be coming into the business, coming through the business, and coming out of the business. The quicker you can turn that cash over, the quicker a business can grow. If that cash gets stuck, in stock, it gets stuck in overheads, it gets stuck in things that aren't moving it forwards, then it's like an oxbow lake. The river starts to go stagnant and everything sort of grinds to a halt. So just because you've got no money in the bank account isn't necessarily a bad thing, as long as money's coming in and as money's going out. As long as that flow is going, then that's still good. To me, that's a sign of a healthy business. So you've got to look at ways to keep that cash moving and not get complacent. That's really one of the key things the finance director should be doing, is looking constantly at the balance sheet, because that's what they own, constantly the overheads, and making sure that the sales, marketing and operation directors and the HR director get all the information they need in order to improve their numbers. It's not the finance director's job to do that. It's their numbers. They should provide the numbers and provide a bit of accountability as well. Aged debtors, you've got to look at your aged debtors on a regular basis. And credit control is so important. Having systems and processes in. Again, don't make it emotional. In small businesses, debt collection becomes emotional. Oh, I can't chase that customer because they might not buy from us again. Well, you never made the sale until you've actually been paid. So I get a lot of my clients now, we put into the terms and conditions, if the invoice isn't paid on time, there's a 5% per month interest charge. Okay, you send somebody a 5% interest charge on their invoice, it's amazing how quickly they end up paying your bill. Because it's not that they can't pay it, it's just they choose not to pay you because they've got more pressing people that they need to pay. So you've got to become the thorn in their side that makes them pay you first. He who shouts loudest loudest gets paid first. Okay, so there's got to be a process here of getting statements out, invoices out, making that phone call, following up that phone call, passing over to the debt collector. Yeah, it's not emotional. Don't think it's just a process. You know, if you're not the person to do chasing debt, give it to somebody that doesn't care. You know, that can be, you know, the bastard and just phone someone out and say, look, I'm just here to do a job. You know, pay me the money. Pay me the money. Okay, more businesses go bust because they don't chase money than probably any other thing.
Be the nice guy all the time.
So we can look at that. You know, there's our sort of typical aged report, so we can sort of see the percentage of, you know, items in each of the columns. But one of the key performance indicators you can look at is debtor days. So that's your debts outstanding at the month divided by your sales times 365. So you can say my average debtors are 30 days, 60 days, 90 days. And then you set that as your goal. And then you put your processes in place, and your aim is to reduce that down as close to 30 days as you possibly can. There's a game that we're playing. You can hand that over to one of your team and say, right, that is what I'm holding you responsible for. We're currently at 75 days on our debtor days. You need to get that down to 45 days in the next 3 months. Okay, if you get that, then I'll buy you, you know, I'll buy you a meal out. You know, I'll buy you a bottle of champagne. You know, I'll give you a pay rise. You know, make it a game and reward success within that game. But the number you give them, they need to understand how to record it. They need to be in charge of their own numbers. If you give somebody a number to work on, yeah, and don't tell them the score until 6 months later, how are they going to know what they're doing? Okay, people are motivated when they own their own numbers. You know, that's why I play golf. You know, when I play golf, it's my responsibility to keep track of my own numbers, not somebody else. I don't play a round of golf for 4 hours and then come into the clubhouse and somebody says, well, you did pretty crap today. You scored 97. Yeah, I know every time I swing a golf club, you know, what my numbers are going to be. And that's what motivates me to play more and try and get better, because I can see my numbers and therefore I can adjust on a day-to-day basis. We're too often within business, we hold our numbers close to our chest because we don't want to upset our team, because if our team see the numbers, you know, they may think we're making too much money, or they may think we're not making enough money. Okay, the team don't really care as long as they're happy, yeah, and as long as they're paid what they think they're worth, then most team members are fine. Yeah. Does anybody working at, I mean, who was the latest financial results that came out? I think it was Shell and BP, wasn't it? How much profit did Shell make in the first 6 months? I think it was about 9 billion. Yeah. Do you think when they made 9 billion, you know, all the workforce of Shell knocked on the MD's door and said, oh, you made 9 billion today, can I have a pay rise, please? I think I should have some of that. Well, yeah, you can have some of that. Buy some shares in Shell, then you get some of the profit. Okay, profit and loss account. So, you know, it's as simple as that. I mean, okay, when you see it in the flesh, it's far more complicated because each one of these is broken down into its component parts. But it's just that sales, cost of sales equals your gross margin, overheads, your net profit. Now, one of the questions people have is what goes into cost of sales? Okay, and I always say it's the big numbers. Okay, if it's a big number, it really should be above the line. If it's a smaller number, it can go below the line. So it's really the numbers that are associated with the sales that we do. So if I didn't make that sale, yeah, I wouldn't have that cost. So if you look at your business, I said, right, rent, okay, rent of the building, is that a cost of sale or is that an overhead?
I say overhead.
Overhead, yeah, because if I didn't make any sale, yeah, would I still have to pay the rent? Yeah. Okay. So if I had a ton of steel to make something, that would be cost of sale, wouldn't it? Because if I hadn't made the sale, I wouldn't have to pay the for the steel. So what about salaries then? What about wages of my workforce? Are they overhead or are they cost of sale?
Overhead.
Overhead? Or all of them? So if you had no sales coming in, Drew, for the next 6 months, would you employ all of your people?
No.
No.
No, you wouldn't, would you?
No. So basically, those people who you would sack, yeah,
Your
are
operational staff.
Are operational cost of sales. Those people that you would retain, who are there to drive the sales, yeah, and record the finances, would be overhead. So you've got to split your salaries into direct costs, people that actually touch what we sell, are part of what we sell, and those people that are supportive and behind the scenes. I see too many profit and loss accounts where all of the wages are down the bottom, and it's generally the biggest number on the profit and loss account after sales, and it's stuck down at the bottom. No, I want it top and central. Okay. How much I get out of my team is one of the most important key performance indicators that we can get. And I'll come on to that in a minute. Any questions on the profit and loss account? It's quite. I don't want to spend too much because I did a survey on LinkedIn. I don't know if you saw it, and said, yeah, what do people struggle with? And most people understood the profit and loss account. It wasn't a difficult one. So.
Yeah, it's quite straightforward. Zero makes your life so much easier. Just hit a button and
exactly. But I would say in Zero, its reporting isn't great. It just chucks everything as one. So use the edit function and group things. So establishment costs, sales costs, make smaller numbers, bigger numbers.
I've got a bookkeeper, so she understands, like, rather than me doing it and watching it. Yeah. You do a better job.
Okay. So then we need to make sure that we've got budget. So we're now predicting what the business can do. So we're starting to set targets, what if analysis. They're setting our goals, be, do, have. Now we're starting to set what we want to achieve. Okay. So, what is our sales target? If we're currently $500,000, what does a £750,000 business look like? What does a £1 million business look like? What would its direct cost be? What would its overhead structure need to look like? It allows us to put a stick in the ground and measure our progress to and from that stick. Okay, if we don't have something to compare something to, then it's not helping us at all. If I said to you, my business made £1 million of profit last year, yeah, would you think that's good or bad?
Pretty good.
Pretty good. Yeah. Until I told you that last year it made 100 million.
Even better.
No, last year it made 100 million. This year it made $1 million. So is the million now good or bad?
No, that's bad. That's kind of bad.
Okay, so something can only be good and bad when it's related to something else.
Measured, yeah.
Now, if last year my profit was $1 million and this year my profit was $1 million, is that good or bad?
Bad.
Bad. It hasn't grown, is it?
Yeah.
Yeah. If I say my budget was 10 million, yeah, is my £1 million profit good or bad?
Bad.
Really bad. Okay, so we've got to have something to compare a result to. It's like when I go and play golf, I shoot 89. Well, is that good or bad?
Average.
but how is it
That's pretty
average?
good.
Because
It depends on what.
you compare it to par, which is 71. So I'm
Yeah.
18 over par. Yeah. And my handicap is 18, and therefore it's okay. If I'm a scratch handicapper, yeah, and I shoot 89, it's bad.
Yep.
If I'm a 50 handicapper, it's bloody amazing. Okay, so a number without something to compare it to is pointless. It means nothing. So when you look at a profit and loss account, you should always look at it next to another period. When you look at a balance sheet, you should always compare it to a previous balance sheet. Yeah, and the budget allows us not only to compare backwards, so the rear view mirror thing, that allows us to compare to what we expected to happen. And yeah, whether it's good or bad doesn't really matter. If my target was 10 million, I made 1 million. Yeah, okay, it's not great. Yeah, but emotionally, it is what it is. I can't do anything about it because it's history. It's done. All I can do is do something about the future. Okay, what lessons did I learn from that? What do I need to do differently? So we've got to get the emotion out of it and then just make decisions based on what the numbers are showing us. We need budgets to get funding. So you know, if you want to go out into the market and get some borrowing, you've got to be given budgets and forecasts of where you're going to be. And for me, it sets your RAS, your reticular activating system. It allows you to focus on something going forwards. So if we want to look at a typical budget, if you want a copy of this, Drew, I've got one of these I can send you. But this is the top line.
One, thank you.
Yeah. So this is the top line. So sales, direct cost, direct labor, gross profit. Then we've got our key areas of overheads in here. And we break this down into more detail. So we start saying, well, what are we selling? What units are we selling? How much are we selling them for? So now we've got average transaction value. We've got number of transactions. If you wanted to, you can add in here leads, conversion rates as well. You can build up the picture from that. That gives us our sales value. And we bring in our direct costs. So what costs associated? If we've got labor, how does the labor work towards that? So we're starting to really break down our business into its component parts. Because we don't understand how our business works, how the hell are we going to play the game? How are we going to get better? Yeah, most businesses I come across is just a jumble of, well, we do some stuff, we get paid for it, and we pay some money out. You can't build a business, you can't scale a business with that limited understanding of your numbers. It's impossible. And then you break your overheads down, into these key areas, and you break those into its component parts. So we can look at it from an MD's point at this level. I'm on the wrong screen. So we look at so as an MD, I'm looking at this level. Yeah. As an operations director, I'm looking at this level. Okay, because I want to know where my costs are. As a sales and marketing director, I'm looking at this level. If I'm a finance director, I need to be looking at this level because I need to be knowing, right, how can I save some money on my rent and rates? Yeah, have I renewed my heating contract? Yeah, am I getting the best deal for my insurance? Is my return on investment for my sales and marketing at the right level? Do I need to go and talk to the sales and marketing team? Okay, if we're not spending time looking at the numbers, then we can't make these decisions that we need to make. And then once we've got all of that information, then we can start looking at comparing our actual figures to last year and to budget. So we look at backwards to where we were and we look forwards to where we want to be. Now, the beauty, again, with zero is we can build all of this into zero and we can get this at a push of a button. Unfortunately, Gareth...
Why are we not using zero?
Yeah.
Another discussion.
Unfortunately, we lost our financial controller a year ago, and we haven't had the resource to make that change. But it's on the list to make that change, Gareth. It's a key thing we've got to do because the system we've got at the moment we're not able to do what we need to do from it.
No.
So any questions on that side, on the...
You mentioned reticular activating system. What's that?
So if you come to my my self-mastery one, I'll talk about it a bit more, but it's part of your brain that filters out stuff that you don't need to know. Okay, so if I do a little example to you, if you look around your room and count the number of red things you see. Okay, so both of you just get around the room, how many red things do you see? Okay, so how many do you see, Gareth?
3.
3 red things, Drew?
4.
4, okay. Right, keep looking at the screen. How many green things did you see?
Just the numbers.
None.
Well, you did. You saw them.
Green.
You couldn't help but see them, but I set your reticular activating system to look for red things.
Yeah.
So you only saw red things.
True.
So when you set the budget, it sets your reticular activating system to start looking for things to help you achieve the budget. If you don't have a budget, you miss all those green things. Okay, so if you read the book, there's a book called The Secret about the law of attraction. It's a load of bollocks, but it's basically the reticular activating system. By setting goals, you set that part of your brain to filter, that focuses on what you want and filters out what you don't want.
Oh, got you.
Okay, that's why when they say you're playing golf and you're standing, on the tee and there's a lake in front of you, and you go, don't hit it in the water, don't hit it in the water, don't hit it in the water. All your brain hears is hit it in the water.
Yeah. Been there, done that. What water?
So it's a very powerful part of our brain, but it's quite dumb. So you have to program it. You have to program what I want to achieve, not what I don't want to achieve. If you sit there going, I don't want to be broke. Then all your brain is saying is, don't be broke, which means don't spend any money, which means you miss all the opportunities to make money.
Sure.
Okay, so that's your budget, so your profit and loss account, and then your budgets come from that. Then you come onto this lovely balance sheet. Okay, and this is the one that most people in business fail to really understand, and they just don't look at enough. And I've seen businesses that go bust because they forget about the balance sheet. They look at the profit and loss account and they think this is, we're making money, and then they go out of business and they wonder why. Yeah, but we're making loads of money. But why have we gone out of business? It's because they didn't look at their balance sheet. So the profit and loss account is like a video. It's a playback of the video of what's happened in your business over a period of time. So profit and loss account is for a month, for 3 months, for 6 months, for 12 months. The balance sheet is a snapshot. Okay, so if you imagine money's coming in, it's going out of your business all the time, it's constantly moving all the time, and then you go freeze. Right, where's my money? Okay, because my money's coming in, it's going out, it's coming in, going out, and you're basically going to go, right, freeze. I need to know where my money is at this point in time. It's normally a month end. Okay, could be a quarter end, could be a year end. So we're basically saying, right, money comes in and money goes out. And the way that we account for this within accounting systems, and this goes back thousands of years, is a system called double entry bookkeeping. Yeah. For every in, there's an out. Okay. So, and we call them debits and credits. So for every debit, there's a credit. So for and debits basically look after where the money's gone, and credits look after where the money's come from. So money comes in and goes out. Because if I said to you right now, Drew, in your business, how much cash have you got in your, actually physically in your business right now? How much have you got?
I know the answer.
Yep.
Yeah.
Physical cash that you could show me, pound notes.
Oh, pound, not physical cash. It's in the bank account.
Yeah, but it's gone somewhere, isn't it? You don't have it. It's in the bank account. So it's gone to the bank account. So physical cash, how much have you got?
No.
None. Okay. So therefore, your business is worth nothing. Yeah, because you don't have any money. It's gone somewhere. So the money's come from somewhere, and it's gone somewhere. So the balance sheet counts for those where it's gone because it's not in your hands right now. Does that make sense?
No,
No.
Okay.
the bank is yours. Your bank is
The
your
bank,
banker.
yeah.
No, the money, but the money is not in your hands. It's in the bank's hands. So it's gone to a bank account.
My bank account, yes.
You
So the
own
money
it.
is mine.
I'm not saying you
Yeah.
don't own it. I'm saying the cash is not in your hands.
Mm.
But if I took the cash out and put it in my own hands,
Yep.
it would be the same value that's in my bank account.
Yeah, it would be. Yeah, but all the balance sheet is doing is recording where the money is because it's not in your hands right now. Yeah, if we can agree that it's not in your hands right now,
Sure.
yeah, therefore it's gone somewhere. So where your money goes to is it can go into assets. So your money's come into your business and it can go into land and buildings. You could buy the building. It could go into plant and equipment. It can go into motor vehicles. It could go into investments. Okay, it's not in your hands. It's gone into an asset for the business. Now, fixed assets are assets that generally last more than 1 year. So if I buy a building, I'm going to own it for more than 1 year. If I buy a motor vehicle, it should last more than 1 year. Okay, so we've got fixed assets and they can be tangible, which are things I can go and touch. So computer screens, computers, land and buildings. They can be intangibles. So give me what would an intangible, something I can't touch be?
Investments.
Investments.
Stocks and shares.
Stocks and shares. Yeah, goodwill if I buy a business. A website, I can't physically touch a website. It's an intangible. Okay, so my money's come in, but it's gone into one of those assets. It can go into current assets. So it can go into stock. So I can buy things and it's in stock. I can lend it to my customers, which is my trade debtors. So I've lent it to you. But you're holding it and going to pay it back to me. It can go into my bank. Okay. If you do own cash, if you turn around to me and said, I've got 50 quid of cash, then I'd say, well, where is it? And you'd say, well, it's in the petty cash tin. Okay, so it's gone into a petty cash tin. So it's there physically. If you don't have it in your hands, it's gone somewhere. Okay, and you can lend it out to other people. So debits within a balance sheet is where the money's gone. Now, debits within a profit and loss account are your expenses. So my money's gone on paying the rates, paying the rent, paying the staff. It's left the company. So this is what the company owns. Expenses of what's left the company. It's no longer, I don't own it anymore. It's gone somewhere else. The credits is where the money's come from. So we call these liabilities. So I can borrow money from, get an overdraft. So I've borrowed it from the bank. I can borrow money from my creditors, the people I buy stuff for. They give me terms. So they're basically lending me the money to buy the goods. I can borrow it from taxman, okay? Because I collect their money, their 20% of VAT, and I don't have to pay it to them for 3 months. I can take out loans, okay? And I can not pay for things that are coming in later. So, like electricity, I use the electricity and then I pay for it later on. Or I've got my owner's equity that I can actually invest in my business, so my shareholders' capital. I can leave money in the business from reserve, so previous year's profit that I haven't taken out. and this year's profit or loss. If it's a profit, then it would be on this side. If it's a loss, it's on this side. Okay, so the balance sheet is, everything's moving on a constant basis. The balance sheet is a snapshot that says, right, where's my money? Okay, I've got some money over here. I've got some money over here. Where did it come from? I borrowed some money and I made some money in my trading, my day-to-day income from my customers, which will be a credit, less the expenses, which is which is where it's gone, gives me my profit at the end of the day. So you can start to see here that I might be making loads of money. If it's gone, my stock, my trade debtors, if I've invested too much in land and buildings, I won't have it physically, and therefore I might run out of money, and therefore my business will fail. Other people say, well, borrowing is bad. Actually, if I borrow to buy an asset, it's good, because that asset will generate me more profit. Okay, so this is a very different way to look at a balance sheet. Yeah, I think I'm the only person on the planet that teaches it this way, because I found it very difficult to actually get people to understand why we have a balance sheet. But once you understand, money's coming in, it's gone somewhere, you've got to identify where it's gone.
Makes sense.
Drew, any question as newly appointed finance director? What would your question be about this?
I don't have any questions. You've explained it very well.
Cool. So here's an example then of a balance sheet taken from zero, I think. Yeah, we've got our assets up here. So my money's here. I've got, okay, it says cash, but I've got 167. Oh, let's take this one, 2018. 139,000 has gone into the bank account. So the bank are looking after that for me. I've got 7,000 that's owed to me by my customers. So I've lent them the money to buy my stock. Payments are things I've paid for in advance. So things like rent, I might pay a year's rent in advance. So that's an asset that I'm going to get the benefit of in the future. I've got my property. I've bought some equipment. I've bought a bit of goodwill. So that's where £300,000 has left my hands and gone somewhere, of which I still have ownership of, but the cash isn't there. In order to fund that, I've borrowed £5,000 from my customers. I've used up, I've used some stuff I haven't been billed for, which is my accruals. I forget unearned revenue. I've borrowed £30,000 on a long-term basis. I've got some other loans. I've got 170,000 of money that I've put in, or my shareholders have put in, and I've retained £90,000 of cash from previous years. So this figure here, 305,483, agrees to this figure here. It's why it's called a balance sheet, because it must balance. If you ever see a balance sheet that doesn't balance, you just throw it back at whoever gave it to you, because it's meaningless. Okay, so if I want more cash in my business, so if I want this number to be bigger, I have to reduce all of these numbers or increase all of these numbers. So everything is, whatever I do one side, I have to do the other side, which is what we call it double entry. And that's why accounts are pretty fail-safe. They should always balance. And in the old days, we used to have to do it, with calculators and spreadsheets, or even manually, and it was prone to human error. Now computers don't make errors, or they shouldn't. They do make errors, because I have seen accounts where the system's gone wrong. So as a finance director, Drew, you're in charge of the overheads on the profit and loss account. You're in charge of making sure the reporting is done on time and accurate. You're charged with ensuring the balance sheet is up to date and the money's in the right place. And that flow is working and we are getting the return. So if I've got £239,000 of cash sitting at the bank earning 0 interest, yeah, am I ensuring the financial security of my business? No. Okay, so I need to be thinking, right, either need to invest this, yeah, or the shareholders need to take it out. Okay, because we don't need it. We don't need £230,000. So shareholders take it away. You take that. You go and buy yourself a holiday home. Go and buy yourself a Ferrari and enjoy yourself. If I can invest that, put it into some more property, more equipment, or put it into more people, and I can get a good return on that, better than I can at the bank, which is currently what, 3-4%, then I should seriously consider reinvesting that business in order to grow the profit of the business. Otherwise, I'm not playing the game of increasing profit and shareholder value. Okay, so this is where we get the financial security. Yeah, make sure the money's in the right place. On the profit and loss account, you've got your sales director, your sales director, your marketing director, your operations director should be driving gross profit, and you take care of the overhead to make sure the overhead is in balance with the sales. Too much overhead means we're going to go bust because our margin isn't strong enough. Too little overhead means we're not going to be able to grow as quickly as we should be able to grow. So those are the key numbers. The final area then is looking at the key performance indicators, and this is really breaking the business down into its component parts. Measuring what matters. Looking at how we're actually performing, and this really breaks it down into these key areas. So overall, the shareholder is looking at that. Basically, all they're interested in is the net profit. Managing director looks at the sales, gross profit, direct overheads, net profit. Finance director looks after the overheads. These guys look after the rest of the profit and loss account. But within that, then the sales and marketing need to be looking at their funnel. So Drew, obviously you come from a sales background, don't need to teach you this. But, we need to know what our funnel looks like. Okay, so where are my leads coming from? What sources of marketing are working? What is the return on investment of each of those sources? Of those leads that come in, which ones convert the best? What's my average transaction value? Now, the challenge you've got within R&B, Gareth, is you're actually playing a number of games within the one game of R&B. You've got the consultancy game, you've got the project game, you've got the reactive game. They're all completely different games. So we've got to be able to break these down into component parts to be able to understand which one of them is making money. Which one should we try and work at and play better? So, we want to start, overall within this is the 5 ways. This is why the 5 ways was devised, because how many leads do we get? What's our conversion rate? What's our number of transactions, transaction value, and what's our gross margin? Okay, so that's I would say is the basic starting point, and then we break that down into more and more bite-sized chunks when we've got the resource to be able to. There's no point in recording this information if we don't actually do anything with it. So it's got to be as we grow, we become more and more intricate with the actual numbers that we're looking at. Operationally, on time, on budget, on spec. Okay, so those are the 3 basic ones that we need to do. Are we delivering our projects on time? Are we delivering them to budget? And are we delivering them to specification? So therefore, we've got to look at our limited resources. there's always a limited resource. Is it time that I've got a limited number of people, and therefore our KPIs are based around time? Is it machine throughput? So if I had a sausage machine, it can only produce so many sausages. What efficiency is it working at? Is it the number of people? So if I'm employing loads and loads of people, is it the number of people per turnover? So every £100,000 turnover, I need 3 people. Is it materials? So I'm a cost-based business where I need to really focus on the materials that are limited in resource. Is it space? If I've got, again, a factory, if I'm trying to make things, I've got a limited space. So, is it space that I've got to look at my KPI on? And it sort of doesn't matter as long as you're coming up with a rate per something. That's how you know you've got an operational KPI, a rate per something. Rate per hour, rate per meter squared. So supermarkets work on a return, so profit per square meter. So how much profit do I make per square meter within my superstore? Because if I've got one product that's selling at £100 per square meter and I've got one that's selling at £10 per square meter, I want to sell more of the £100 per square meter because I can't have any more space in my superstore than what I've actually got. True, if your limited resource is people, then it needs to be at something per hour. How many hours have I got? How many calls do I do? What is my return per hour that I'm spending on? Gareth, because of the nature of R&B, you've got multiple ones of these because consultancy has a different, KPI to production. Production has a different one to actually installation. There's so many games, and that's where it becomes quite complicated. And we have to take a step back, and we don't have to measure everything in one go. We just want to measure what do we want to improve the most right now, then measure that one. And once we've got that plate spinning, then move on to another plate.
Sure. And
we are looking for these marginal gains. We're looking for the 1% improvements, 10% improvements. The more you play the game, the better you get at it. There's always ways you can improve. So even if you think you're doing well, then okay, do it in more detail. Break it down further. Because the game that people are playing is the game of improvement. No one wants to play a game and not improve. I don't go out and play golf and shoot, I'm probably shooting around about 78 at the moment. I don't go out there just to shoot 78. I go out there to shoot 75. I go out there to shoot scratch. I'm playing tennis this evening. I'm going out to improve, to play, to win. That's what brings me back to playing sport. If we're not winning the game, and our team are not understanding what winning looks like, then they're just turning up and going through the motions. And how can we expect to get the best out of them if they're just going through the motions? They need something they can go, yeah, I did that. I got that improvement. I did a good job today. And final area then is people. How do we measure? And this can be one of the hardest ones, but we can still measure it. What is the sick leave? Because if people are taking lots of sick, it's generally because they're unhappy. Absenteeisms, do a happiness score. I've got clients that do a survey every 3 months and says, okay, how are people on these 5 criteria? How are people happy? At least do appraisals, appraise people individually. What do you think your performance is? I think it's a 5 out of 10. Great. How do we get it to a 6? What's our engagement? There's ways to do employee engagement. And it's probably more for a bigger organization, but you can actually test what their engagement level is. What's your growth? How do generally employees assess how well they're doing in their business, in their jobs? Sorry, Drew? I've lost sound somehow. No? Oh. That's odd. So, Gareth,
I can hear you. I can't hear Drew.
I can't hear Drew. No.
It's
The
AirPods.
speakers have gone quiet. I think you said pay, didn't you, Drew? So yeah, pay. You know, if I'm paid more this year than I was last year, then I'm improving. Okay, but if that's their only feedback on how well they're doing, that's a bit of a blunt instrument, isn't it? So if I get a 5% pay increase because of inflation, does that mean I've done a good job this year or not a good job this year? I don't know.
See where you're coming from.
Okay, so we've got to give our team the numbers and the way to assess their own performance so that they can see it. And so I'll give a little demonstration. So we're going to play a little game, Gareth. We're going to play 10-pin bowling. Have you done 10-pin bowling?
Yep.
Okay. So 10-pin bowling is our business. It's the game that we're playing. And you know, I'm a bit of a secretive boss. Okay. So I've got the pins here. Okay. And I'm going to put this little blanket in front of the pins. And you're going to play the game by rolling the ball down and not pins down. Okay. So roll the ball down. Okay. Goes through things. You can hear some pins being knocked out. Okay, so let's play this game again. Try again.
Down it goes.
Goes through. You can hear some more pins go down.
Yeah.
Okay. Right. So we'll reset now because that's how you do. You have 2 goes, and then we reset. So we're going to go another go. Are you enjoying this game?
Nice. I don't know how many pins I'm knocking down.
Yeah, you're bowling the ball. So if I paid you £30,000 a year, yeah, to bowl a ball down through there and not be told how many you got down, would you carry on playing the game?
As a normal employee, probably yes.
Yeah. Yeah. If I don't have a choice, but if I had a choice, I probably wouldn't play the game. So we're going to play the game a little bit better now, yeah? Because I'm a good manager. So you're going to bowl the ball. It's going to go through here, yeah, and you're going to knock some pins down. Go on. Great job, Gareth. You got 3 down. Fantastic. Well done. Okay, so have another go, see if you can get some more down. Goes through. You got 5 more down. That's 8 overall, Gareth. There's only 3 left up. Really good going. Okay, are you enjoying the game more now than you were just a minute ago?
Kind of.
Kind of. Okay, it's better, but it's not great, is it?
No.
So what do I need to do?
Move that piece of paper so I can see exactly how many pins I'm knocking down.
Get out of the fucking way.
Exactly.
Okay. So where's my time better spent? Is it at this end, holding the piece of paper up, telling you what you've got down, or coming round to your end and going, right, Gareth, bowl the ball.
Bang.
Okay, how many pins did you knock down?
10.
10. Fantastic. So what did you do really well there? What did you do differently that time than you did last time?
I got you out of the way and I could see where I was going.
Great. Do you think you can repeat that again?
With or without the paper in the way?
Without the paper.
There we go. Bang. There you go.
Okay, so let's say you didn't get 10 down. Let's say you only got 8 down this time. Okay, so I'm there to help you. So look, Gav, you got 8 down. Do you know why you only got 8 down, not 10 down this time?
No.
Yeah, it's because your release was slightly wrong and you didn't twist the ball. So if we work on that spin a little bit more and you hold the ball this way to get it round, then I think you'll be able to get 10 down next time.
Cool.
Okay, so I can coach you now.
Sure.
I can spend the time with you improving, not being the person that I'm just there telling you your numbers. Okay, the more we can get people to have ownership of their own numbers, the easier our job is. It's far more enjoyable for me as a manager to do that. Yeah, and far more enjoyable as you as a player to do that.
Sure.
Yeah, in small businesses, we have this bloody veil that we hold up because we don't know. Not that we're hiding it, it's because we haven't fucking got a clue. And if I haven't got a clue, how the hell am I going to tell you what your numbers are?
Yeah. No,
so we've got to get the visibility in the business. And A really great book for this is this book by John Doerr, Measure What Matters. Okay, it's a very good book, simple ideas that drive 10x growth. So this is about that multiple within the business. So home fun. Okay, Gareth, you're not going to be able to do some of this, but Drew, get that budget, get that reticular activating system on the future. Make sure that we've got that monthly profit and loss and balance sheet, and we understand it. And the people in our team have got ownership of their part of it. Think about your limiting beliefs around numbers. Are there some things you need to work on, about that positivity? And then it's probably more relevant for you, Gareth. What is your KPI dashboard? Take ownership of your own numbers. What's important for me? What does success look like for me? Don't wait for don't wait for other people to tell you what it is. Set your own. If you're in sales, right? Mine is conversion rate. What is my conversion rate? I don't know. How do I find out? Okay, I'll have to work at it. It's marketing. It's lead generation. If it's operations, it's on time, on budget, on spec. Take ownership of your own department, because if you're playing the game of 10-pin bowling without a blanket in the way, it's a far more enjoyable game. Cool. So, Drew, your goal was to understand more about what a finance director does. Have I given you enough to do that?
Yes, you've.
We got sound.
The positive is. So yeah, my AirPods died and I just moved to speaker,
okay.
But I'm back there. But the really good news is that I'm doing majority of the things that you said. So a lot of it was to come and make sure that I am doing the right things. Obviously, the bookkeeper does majority of it, hence why I'm employing her. But I think the main thing I've took from this is the emotional belief around money and trying to change that mindset regarding the capital in the business.
Yeah, the one thing I do this, and it's a bit of it's a bit of an Asian thing. I've done this a lot with my Asian clients. Have you got a coin or something you can put in your hand?
Yeah, okay. Not a coin, but
okay, so that's good enough. So put your hand out like that and put it in the hand. Okay, now treat that as your money. So what if that was all the money you had in the world? What would you do?
Tighten my grip a little bit.
Well, so that's all the money you've got. So
I wouldn't tighten it 100%.
Okay. But let's say that you did tighten it 100%. Let's say you really want to hold on to that money. Okay. Now, if I came along and tried to put more money in that hand, could I do it?
No, because it's fully closed.
Exactly. Okay. So you need to have a loose, tight grip on that money. Tight enough to hold on to it, but loose enough to allow more money to come into it. And that's the big thing as a finance director. You have to understand. Most finance directors are like this. No, you can't have any. No, we're not going to spend. No, we can't afford it. No, we can't afford it. No, we don't have the money. Okay, fine. Well, let's get the money. If I believe enough in what I'm doing that's going to give me a return on investment, then we have to invest. Okay. So, Gareth, yours was about sort of addressing people and sort of the numbers. I think for you, that organization chart where the numbers sit, that should be the big one for you to understand, where you sit, but also the challenge we have in a small business where we've got somebody in so many seats trying to do so many things. And unfortunately, the big thing we've got with R&B is we're a little bit lacking on the finance side at the moment. That's the bit that Clive is working on. So, hoping to address that in the not too distant future.
Yep, small steps.
Cool. Well, look, it's been a pleasure, guys. Thanks very much, Drew, for attending. Love to see you on some more of these going forwards. And obviously, if there's anything I can help on a ongoing basis within that, helping you move forwards, you know where I am, and love to be part of it. So, and Gareth, I'll catch up with you when I'm up in
Yeah.
Andover next.
Yeah, lovely. Thanks, Kevin.
Cool.
Nice
Take
meeting
care,
you.
guys.
Thank you
Have a
so
good one.
much.
Bye for now.
Take care.
Cheers, guys.
Bye.
Bye-bye.
Bye.
Bye-bye.